Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone. Welcome to today's edition of our AWA Market Minute. We're super excited to be here with you. I'm Paul Coles. With me, as always, is our co-host Scott Hoxer, Chief Investment Officer of our firm. Scott, today's the day that we've been waiting for since college basketball season started. We can finally start paying attention.
That's right. That's right.
because today is the opening of the NCAA March Madness tournament. No spoilers.
Yeah, no spoilers at all. I will say it is one of my favorite sporting events to watch. And to your point, the postseason with college basketball in particular is hard to beat.
It's great.
Yeah,
it's great. Yeah. We can all we also call this like the homage to multi-monitors work week, right? Where we can kind of have multi-monitors up and you're working here, but maybe every now and again glancing just over to the right a little bit and watching what's going on there. We have an office pool going here where we all jumped in on these brackets, and my bracket name was Gray's Sporting Almanac, and nobody picked it up in the office except for Elisa. It's a nod to Back to the Future 2.
Yeah, that was Biff's book, right?
That was Biff's book.
Yeah.
That's how he became so wealthy. So he knew the odds. He knew how to pick on the winners, obviously, because he had the almanac. Any guesses, Scott, as to what the odds are of winning a perfect bracket? Perfect, like every game, all the way through.
Yeah, mathematically, I'm trying to think through that in my mind because with each round, you have to nail every one of those. It's astronomical.
It's astronomical. So I cheated. I looked it up. So it's 1 in 9.2 quintillion. Okay, unless that number gets lost on anybody, a quintillion is a billion billions. Okay, so 1 in 9.2 quintillion. So that's if you just flip a coin on every game. So they do have a Georgia Tech professor who says, look, this guy is a statistician, and he says if you have some information on the teams playing, then you can do about 75% of the time. You can guess the correct team about 75% of the time if you know a lot of information and you've used the information. And in that model, you've really drastically improved your odds. Any guess on that version?
Oh, 1 in a trillion.
It's not quite that high. It's 1 in 120 billion.
Okay.
So 1 in 120 billion. And I think Warren Buffett used to actually underwrite a $1 billion giveaway for the perfect bracket.
Yep.
Right. He doesn't. I don't think he does that any longer. But I think that's kind of fun. So everybody get in your brackets. All of our clients get to enjoy March Madness as well. So Scott, just a couple of fun headlines I thought we'd kick around. Today's also the day that Reddit went public.
Yeah. Super interesting. So I think a lot of people are familiar with Reddit, just an online platform that covers every topic under the sun. It reached a lot of notoriety a few years ago as it was a forum for people to pile on with certain stock trades, and really, a lot of people felt like empowered the masses.
Yeah.
Trade against Wall Street in some instances.
Well, yeah, I mean, specifically, the one that became super famous was GameStop.
Yeah.
And the Reddit users, had this forum to communicate and, like you said, kind of, amass the common people, and they were able to trade on GameStop and drive the price up while hedge funds were, trying to short the stock, and it ended up causing this significant financial, catastrophe for these hedge funds who were shorting the stock. And it just kind of showed the power of Reddit users. And the irony of all of this is now that Reddit is going public, the Reddit users are trying to short that stock.
I saw a headline yesterday and it said, "Can Reddit survive Reddit?"
It's so wild.
Which I thought was interesting.
It is so funny. So wild. Well, why don't we bring on our guest host today as we talk through a couple more of the current headlines, Scott?
Yeah, absolutely. Thanks, Paul. So we are super excited today. We have Tim Holland with us today. Tim's joined us previously. He's been widely well received by our clients in previous market minutes. And Tim is the Chief Investment Officer of Orion, which is a firm with over $65 billion in wealth management assets, over $4 trillion in platform assets. Tim has over 20 years of investment management experience and is a CFA charter holder. And his commentary has been found on CNBC, Fox Business, Bloomberg, Wall Street Journal, and many others. So, Tim, as always, thanks so much for joining us.
Yeah, no, thanks for having me back on. It's great to see you both, and good luck with those brackets. If anyone can nail a 1 quintillion, was it? Maybe it's you. It's
1
you
and 9.2.
Oh, 9 point. Okay, so I still like your odds. One of you. I have a feeling one of you is going to do it. So good luck.
Yeah.
Well, if I actually had Gray's Sporting Almanac, then my odds would be fantastic.
That was really good. Yeah, that's a great Biff reference for sure.
Well, Tim, one of the other big headlines, and we want to get your take on this, is yesterday, markets reached, the three indices reached record highs.
Yeah.
And it came on the heels of, the Fed and Jerome Powell making a big announcement. So let's talk about that for a minute.
Yeah. We've got a presentation that kind of digs into what the world looks like when the Fed's done raising rates, and by all accounts, the Fed is done. So I can pull it up in a quick second. I think for me, the big thing yesterday, we write a weekly note, and I've got to take pen to paper on the one that's going to go out Monday. And I'm thinking of titling it The Power of a Dot, because the Fed didn't raise rates and no one expected them to raise rates. But some folks in our business thought, with the sort of inflation data coming in a little hotter than expected, the Fed may say, we're not going to cut 3 times this year. We're only going to cut 2. Now, we'll see if we get to 3. But the fact that they kept that third dot in, even by the slightest margins, because it's a vote, it's a poll of members, I think that was a huge boost to Wall Street and sentiment. So
I think it highlights the market likes predictability, the market likes consistency, and by the Fed sticking to the plan, the market just cheered on and said, hey, we can predict and be consistent with the information if we stick to the plan. And so, kudos to the Fed for saying we're sticking to the plan.
Yeah, agreed. If I can, let me pull up the presentation, because that's a really good point, Paul, in terms of aligning sort of
Andrew,
expectations.
let's go ahead and share his screen.
I'm gonna give it a shot.
Here we go.
Hopefully, you all see what do markets look like in a post-rate hiking world.
Yep.
Okay, good. I'm pleasantly surprised at my technical prowess. And so now, hopefully, you see, and this will be the last time I check, markets are pricing in 6 cuts.
Yeah.
Okay, so, and they're not. But I think, Paul, you bring up a really good point about sort of getting the Fed and the market on the same page and keeping them there. So when we started the year, and we update our decks quarterly from a compliance point of view, so some of the information is a little out of date, but the narrative is still holds. To start the year, the market thought the Fed was going to cut 6 times in 2024. The Fed was guiding to 3. And then what happened was, because Jay Powell said, no, it's going to be 3 times, the market eventually priced in, and is still pricing in, 3 rate cuts. And so the Fed and the market got on the same page, which I think took away a big source of volatility. And the fact that the Fed was comfortable saying, even though the inflation prints were kind of hot for last month, we're sticking to 3. That's a big deal because it does reduce a real potential source of uncertainty. So markets like that, if it's all right with you and Scott, I'll just click through a couple slides.
Yeah, we love it.
and then I'll catch my breath. So so the Fed stopped raising rates in July of last year, came out in December and said we're done, and now they're pivoting to cuts. If you just look at prior cycles, once the Fed finishes raising rates, stocks tend to do really well because the market likes cheap money. Most folks like cheap money. So lower rates, which is what we're getting close to, flatter, as we call it, risk assets. So this just looks at different rate hiking cycles going back to the early 80s and Biff, though I guess that was probably more mid 80s, Back to the Future, which is a great movie. And then bonds tend to do well as even better than stocks once the Fed is done raising rates. So rate cuts tend to be really good for equities. They tend to be even better for fixed income because they make existing bonds worth more. So if the Fed is cutting rates in a couple of months, most folks think they'll start in June. That should flatter fixed income. A couple other points about the market, if I could, then I'll catch my breath. We're in a new bull market. Paul was talking about all-time highs for indices. This bull market got going in June, so we're not even a year into it. And all those sort of mountain peaks and then some of the sort of moves lower are just a reminder that going back 60 some odd years, bull markets tend to go for a couple, 3 years. So it may be hard to believe considering how well markets have done year to date and last year, but we're probably not even halfway through the bull market, which is, pretty comforting. Another couple of quick comments, and again, then I'll stop sharing my screen and we can sort of pivot back. Lots of talk last year about the Magnificent Seven, and this year NVIDIA is the big mega cap tech companies, the interest around AI, and that was what drove markets last year, but gains are broadening out. Lower right, we call out the small cap index, the Russell 2000. That's actually outperformed big stocks since the October lows of last year. And the Reddit IPO is interesting, and we'll see. Can Reddit survive Reddit, which I hadn't seen, which is a great headline, Scott.
Yeah, it is.
The IPO market opening up is a big deal. When bond yields went up and interest rates went up, companies stopped coming public. It's just hard to do in a rising rate environment. So we'll see what Reddit users can do or not do to Reddit, but that could be a big positive for the markets too, because it just speaks to other companies or companies being comfortable trying to come public and tap public capital.
So that is an interesting point, Tim.
Yeah.
The Reddit IPO and is this going to spur on a trend of other companies doing this? One thing I've noticed as I read through the Reddit IPOs, they're being very unique in how they're approaching this. They're selling 22 million shares, but they're holding back a significant number of shares and they're granting those to users. And this is like very unique, right? I've never heard of anything like this before. Is that because, I guess, we don't know, but is your take on that? This is Reddit's attempt at entering a market with an IPO where this is not a friendly IPO market?
Maybe to Scott's point, it's Reddit trying to survive Reddit.
Yeah.
I think, it is a very novel approach to raising capital and going public. If you think about what Reddit is, and to your point, sort of the role it played in the meme stock phenomenon, it really is a user-based, community-based company. So I could see, it's probably less transactional than, buying a pair of Nikes or Starbucks. So people that go to those companies feel pretty connected to those brands too. But really, Reddit's only probably as powerful as the network is, and as sort of if the network's growing. So I think that's probably a smart way to kind of engender loyalty and keep people on the platform. Because if fewer and fewer people are reading Reddit, then the efficacy of the platform just starts to go down, and that can probably be something that's pretty hard to turn around. So that'd be my best guess. So, but that's a really interesting point. The other thing that's out there is there's a lot of money on the sidelines as the dry powder, as folks like to say on Wall Street, and in this, we just graph out that there's north of 6 trillion in money market funds. I think a lot of that money went into money market funds when 2022 was so bad for stocks and bonds, and then the banking crisis that hit about a year ago, and people wanted to get out of the traditional banking system, and money market funds were offering pretty attractive rates of return. If the Fed does start cutting rates, and I know you all know this, the rates of return on those cash-like vehicles will start going down. And there's even an article in the Wall Street Journal today that speaks to that. And we did some analysis, and it shows that CDs, once rates peak, have historically badly performed stocks, bonds, and a stock bond 60-40 portfolio. So if the Fed starts to cut, that money could come back into risk assets, which would be sort of further fuel for what's been a pretty meaningful bull market. So I'll stop sharing my screen for a sec, but hopefully that was
that comment on kind of that money market. You know, we have this conversation all the time with our clients because you know, people like you said, 2022, there was a fear of what the market was doing. Obviously, it was merited, but then simultaneously, we had these money market rates and CD rates. We were offering 5+% for short term. I mean, we're talking 5-6% for a 6-month, 12-month CD. And so, you know, we always kind of knew it was going to be temporary, though, right? I mean, we always kind of knew this was just a holding spot for just a moment, because there's just no way the Fed's going to be able to sustain that kind of you know, inflation, you know, pressure. And so I think we're kind of nearing that point now where we're starting to see, okay, we're going to need alternative options for those quote unquote safe money vehicles. Yeah,
for sure. The phrase I heard, you know, the old, you know, cash is king and cash isn't trash anymore. My favorite was T-bill and chill.
Yeah.
You know, buy T-bills given the rate of return. But again, as those rates start to go down, you're looking at real reinvestment risk or just missing out on, you know, potential appreciation that stocks and bonds tend to really give you once rates peak. So hopefully folks that caught some of that don't get stuck there if that's not where that money should be long term, if that makes sense. So
yeah, I think that does, Tim. And I'd like to maybe go back to something you talked about, and you know, you mentioned the October lows and how strong of a rally we've had since then, and then you also shared that slide where it talked about the duration and amplitude of bull markets, you know, which are substantial. But then within those bull markets, you have kind of micro corrections that occur. As we stand today, are you concerned that the market's gotten ahead of itself? I mean, we're hitting, you know, highs, not just in equities, but things like gold, things like cryptocurrencies are, you know, rallying significantly. Is there too much froth in this market right now?
Yeah, I think that's a great observation given the strength last year and then the carry through into this year. So if I lean on history, and I often do because my crystal ball never works, you know, we've got, in theory, again, another year and a half, maybe 2 years, if not a little bit more, of equities rising, broadly speaking, the S&P in particular. So I expect some pullback, some corrections, 8-10%, maybe low double digits. We're going into a seasonally weak period soon, right? Sell in May and go away. That's not that far away. You've got the volatility that the election will probably engender. Even if the vote should have no impact long-term on the markets, that can create some angst for people. And you've had this big move up. So I wouldn't be surprised to see some weakness, some pullbacks through the summer along those lines. High single-digit pullbacks. History tells you that. History also tells me, though, that we should not see another bear market, meaning a pullback of 20% or greater, for at least another year and a half, if not 2.5 years. So for those reasons, I wouldn't be surprised to see some volatility to the downside over the next couple of months. All things being equal, I'd see it as a buying opportunity for those folks that were under allocated to equities, maybe miss some of this just because 2022 was so tough, and I think knocked so many people sideways.
So we always talk about the correlation between, you know, we go back to the 1950s and chart a line that says here's what the S&P 500 has done, and then here how corporate earnings have tracked that, right? And there's something like a 97-98% correlation between that market index and corporate earnings, which lends itself to the notion that the market's not a zero-sum game. It really does track corporate earnings. I mean, businesses that have assets and earnings are worth money, and when we buy into those and those businesses produce widgets, we can then grow with the growing business. And so, what are you seeing right now in terms of corporate earnings?
So there are a couple of data providers that tend to aggregate what all the analysts on Wall Street think different companies are going to make at the company level and sort of roll that up into an aggregate number for the S&P in particular. And right now, the back of the envelope math is 10-11% year-on-year earnings growth for the S&P 500 this year, which is pretty darn good. Now, the market trades at north of 20 times earnings, so the price to earnings multiple is on the higher end, as we know. But earnings growth should be pretty robust. There's always a potential, if you go back to maybe the poster child for the rally this year and even last year, but I think really this year it's NVIDIA, right? The company that makes graphic processing units and sort of the hardware that allows AI to work from a software perspective. And they reported Q4 earnings that grew 8 times year over year, and the stock was up in value $277 billion in one day, which has never happened
But
before.
It's kind of like the first time we're seeing their PE ratio work, right? I mean,
and because of that, the PE ratio got cut in half. Going into that earnings call for the year, Wall Street thought the stock was trading at 60 times earnings. After they blew out the number and folks realized the momentum the business had, the PE multiple dropped to 30, which is still pretty expensive, but a bargain considering the growth rate. So there's always a chance that you could see more of that this year. But a 20 times multiple on 10 or 11% earnings growth, if the Fed cuts rates, that's a pretty good backdrop for risk assets. Again, things don't go up every day, all day, but if you can avoid a recession, you get low double-digit earnings growth and a couple of rate cuts. I just think it's hard to argue against U.S. equities in that environment. I expect some pullbacks, but it's just really, really hard, I think, to get in front of equities and sort of take the opposite bet.
Yeah, and I think we share that sentiment, Tim. It does feel like there's some pretty strong economic tailwinds that will help the market this year. I want to touch on one thing that you mentioned there, and that's AI, and I think we're interested in kind of your perspective on that. It's hard to open any media and not have a lot of content about AI specifically. And I'm interested in your thoughts. Is it a little bit overwrought or premature at this point, or is this something that's going to have some of the fundamental shifts to the same degree that, say, the internet did? What are your thoughts, Tim, both kind of near term and long term, as far as AI and its impact on the markets?
Yeah, no, I think the internet is a great analogy and a great framework for thinking about AI. I think based on what I've read and the companies we've talked to and some of the things CEOs that are using AI, not even the sort of the AI companies, right? The NVIDIAs of the world and Microsystems and folks like that, that it is transformative from a productivity perspective. It's not just high schoolers using Chat GPT to write papers. What it's going to do in terms of drug and R&D. Call centers, sort of not to be disparaging, but low-level customer service positions. There's some privately held companies in Silicon Valley that have valuations north of $1 billion, and they have AI, large language customer service software models that you don't even know you're not talking to a person. And it's not just press 0 to talk to someone. It's I'll help you rebook your flight, halfway around the world, and you won't even know it's an artificially generated bot that you're speaking with. So I think the applications are going to be huge. My best guess is you'll probably see if this gets really silly, you'll see some of the silliness from a market perspective. I don't think we're there yet. I remember if you go back 25 years when the Globe.com came public, it was going to be this online internet phenomenon. It jumped a couple 100% in a day and it was bankrupt, 6 months later. You remember pets.com. I mean, there's a lot of silliness back then. I don't think we're there yet because those companies haven't even tried to go public yet. So my best guess is you'll get some excess from a market perspective. I think the applications are as transformative as the internet was. And the companies that are public, that are participating in this and benefiting from this, the Microsofts of the world and the NVIDIAs, these are massive companies making billions of dollars. So that's real. Time will tell if the silliness sort of catches up with the real companies that are already public. I think it'll happen. But I just don't think we're there yet, if that makes sense.
Well, here's the deal, Tim. I've seen how this movie ends, and eventually we have to send Arnold Schwarzenegger back in time. We've got to try to save somebody. I mean, I just don't know that we're still going down this path. It's scary.
Yeah. No, that Terminator, when the hand starts to do that.
That's right.
That, Skybot. Yeah. I don't know. I mean, hopefully it doesn't come to that because I'm not going to do well.
No,
I'm a coward. The zombies show up.
I'm not made for this.
I'm running. You guys can fight them. I'll be hiding under my desk. It's pretty wild. So the other thing that's already being talked about a little bit is the gains in productivity the last couple of quarters. It's probably too early to attribute that to AI. And again, at the risk of sounding too optimistic, again, we remember the 90s, the Goldilocks economy, the new economy that Greenspan talked about, where you could have meaningful GDP growth with moderate inflation because you saw such gains in productivity. In hindsight, that went too far and it got silly. But a lot of people are thinking, and I think Powell's buying into this a little bit, that productivity is picking up, the labor force is growing, and Goldilocks maybe hasn't entered the building. But if AI feeds into that, that's a big deal because if we're all more productive, it means we're, for those who believe in a capitalistic economy, we're producing more, making more, we can get paid more, but those incremental gains in wages come out of top line growth without having to hire more people or spark inflation. So, I think that was Powell's message yesterday. There's a supply side phenomenon going on, to sort of use the Reagan term. That if he's right and AI probably helps, that's a big deal.
Well, and Scott talks about this, about our shrinking workforce, right?
Yeah.
And how this is like going to be a real issue that we don't talk about, but it's going to be a real problem as we have a diminishing workforce, and how AI could slide in and start filling the gaps there.
That could save the day. It really could, and that would be a game changer. To your point and about Scott's comments, demographics aren't great. The other thing going on, and not to get into the politics of what is a hot button issue, which is immigration. Labor force participation for prime workforce folks. I think it's 25 to 55. I think is sort of the sweet spot. I'm still barely in that group. I'm going to age out of it pretty soon. That's at an all-time high. Like, folks have really come back finally, but all the baby boomers retiring has been a huge drag. And so the native-born workforce has shrunk on balance because of the boomers. But folks who the sort of immigrant-fueled workforce is up by like 4.5 million, they think, in the last year or so, and even those numbers are probably a guess. So I know immigration's a serious issue. The border is a serious issue. That could also be a big deal in terms of just the economy and economic growth.
And the way I think about demographics, Tim, is similar to other things where the U.S. is maybe like the least dirty shirt in the closet, right? Where our demographics aren't great, but you look at Western Europe or China or other places, and it's far worse.
Yeah, for sure. So we still have the best. We've been dealt the best hand, I think, sort of broadly speaking.
Yeah. So we're kind of rounding the third base here as we kind of wrap up. Just a couple quick thoughts. As we talk about AI and NVIDIA and semiconductors and kind of some of the exposure we might have there, most of that stuff is being produced overseas, right? And then we saw today the federal government grant Intel an $8.5 billion grant to try to do some more domestic production. in this space, and they're putting plants all over the country in Arizona and Chicago and other places. So, from your take, what is our? I mean, that's going to take years, right, to really build up that space. What's our exposure? To this China and Taiwan. I mean, all this stuff happening in Asia right now. I think this is a concern for a lot of clients. What's our exposure there?
So when we think about the portfolios that we have responsibility for, we have a bias towards the U.S. So our sort of neutral U.S. exposure is above what the world's neutral U.S. exposure is, if that makes sense. And we've always had a bias towards growth and high quality growth. So those companies that are participating in this, what looks to be a AI driven revolution, we've got meaningful exposure to up and down the cap spectrum. And by definition, we have less exposure to ex-US companies than sort of what the world should tell us to have exposure to, just because our country's got the world's most important economy, largest, most liquid capital markets or stock market, and we're home to the world's most innovative companies. I think one of the neat things about the Magnificent Seven is they're all U.S. companies, right? And they're all West Coast based. Some people look at California and they pull their hair out, and I get it. It's sort of a love-hate relationship sometimes between the rest of the country and California. But I think 5 of the 7 are based in California. I mean, it's incredible. No one doing anything really meaningful in the AI space is doing it with a company that's not U.S. based, which is good for us. I think to your point, Paul, you have an administration, and I think some people agree or disagree, that's sort of got an interventionist mindset or bent when it comes to the economy, right? So the Inflation Reduction Act, some of the other things that the Biden administration has done, it's all being done with an eye towards sort of reshoring or onshoring a lot of high value manufacturing and production of hardware, which speaks to the Intel grant. I think that's one of the plants is going to go in Ohio, and it's a massive amount of money. So that will take years, but it also speaks to the fact that I think this administration, the Trump administration, I think Washington, D.C. broadly recognizes that China is our primary geopolitical opponent. I think it began with Donald Trump and tariffs. I find it interesting that Joe Biden has not unwound any of those tariffs. And it seems like if there's one issue that unites Republicans and Democrats, it's we sort of fell asleep at the switch as it concerns China.
Yeah.
And so you have Taiwan Semiconductor, which is one of the most important companies in that space, right across the strait from China, and a communist party that believes that Taiwan, in a one China policy, and Taiwan belongs back under that communist leadership. And if that ever happened, to your point, that would just upend global supply chains in an incredibly meaningful way. So I think everything that's going on around the CHIPS Act and some of these other things, which has bipartisan support, is meant to ensure we can produce the hardware from a tech perspective that we need to continue to run this country. And I think the other high profile issue that's come out of DC, which if my 14-year-old son hears about it, he'll probably lose his mind, is that they're going to maybe ban TikTok.
Yeah.
So again, my son probably doesn't speak well of me as a parent, spends way too much time on his phone looking at that stuff.
It's wild.
So again, if you can do that, you can do anything in this country politically. So that's kind of
there's a lot of traction for that here in Utah.
Oh, yeah.
Our state government's working hard to say, hey, we need to get this stuff out of kids' hands. I actually often look at this as, because I've got teenagers right now, and Scott does too. I often look at this particular issue, not to get too tangential here, but as it's the cigarettes of the 1930s, and we're going to look back on this 10, 20, 30 years later and say, wow, we really didn't know what we were giving our kids and how much damage that was causing their brains.
Yeah. No, I think you're right. I think my wife Meredith would agree with you 110%. And for me, the interesting data point out of 2023 was we imported more goods from Mexico last year than China for the first time in 20 some odd years. So I think essentially post-pandemic, post-supply chain concern, right? We couldn't get antibiotics and some of these other things because they were all being manufactured in China. I think a lot of people didn't know that. There is this reorientation towards friendly countries and onshoring, which probably is inflationary, probably drives up costs a little bit, but makes the supply chain much more resilient and protected. And I think it just transcends, and I think that's a good thing. I think it transcends Republican and Democrat administrations, and I think it's something that was overdue. I think the deal we struck with China at some point 5 or 6 years ago started going off the rails, and it took a while for us to figure that out, I think.
Well, we sure appreciate your take there, Tim, and this is awesome content. And at the end of the day, I think what we want to highlight more than anything to our audience here is we're not asleep at the wheel. These are topics that we're very mindful of, and as we talk through, our clients and their retirement accounts, which is they rely on this money to maintain their quality of life and their standard of living during the next 20, 30, 40 years into retirement, and they rely on really good people, competent people that are actively managing, watching over their funds and knowing, kind of how this landscape is evolving to ensure that they're in the safest possible hands. So hearing some of your commentary, Tim, is very helpful for all of our audience. So appreciate that. Scott, anything you want to add?
No, it's been great. Thanks so much, Tim.
That's been wonderful, Tim. Thanks for joining us today.
Yeah, great to be with you. Thank you.
Yep. And to our audience who's on with us, we appreciate you guys. And until next time, take care.